Joining us is Mr. Sanjeev Singh, Chairman of Indian Oil Corporation. Thank you for talking to us, sir. So net profit declined for FY19 compared to the corresponding year. What is the reason for that?
Although we had a profit of 16,800 crore this year, but there was a decline of close to 4,500 crore in comparison to the last year. The major two reasons for this were less inventory gain. This year we had an inventory gain of 3,200 crore, which was close to 2,500 crore lower than the previous year. And we had foreign exchange loss, which was close to 1,500 this year. And while we had a 300 crore gain previous year. So there was an impact of 1,800 crores. Now these were the two major reasons which were beyond our control, I would say, and which impacted this profitability. As far as the physical performance of the corporation is concerned, our marketing volumes were higher than the previous year. Our refineries did 5% more than the last year. Refineries did in terms of physical performance, energy consumption, fuel and loss, they did all-time best this year. So physical performance-wise, the corporation did extremely well, but because of less inventory gain and exchange loss, the profits were impacted.
What's your outlook on GRM for the way ahead for FY20?
They should improve because in general I can say that once the gasoline GRMs do come on, gasoline cracks do come on normal level, the GRM should come back to the normal level. Also, there are indications that because of Morpol 2020, the gas oil or the diesel crack should improve, because a couple of heavy gas oil might get diverted towards bunker fuel, which will increase the cracks for diesel.
So debt levels of the company have increased to 50%. What is the reason for that?
At close to this financial year, the total debt level was close to 86,000 crores. Of course, when we talk today, it's already at a level of 81,000 crores. The one reason was we had an outstanding under recovery dues from the government, which was around 19,000 crore, which is towards kerosene, LPG, PMUY, which was to be received from the government. At normal times, these dues do remain at a level of 8 to 10,000 crore. So nearly 10,000 crore were more than that from the normal levels. So if we consider that, I think we should be lower than 70,000. Last year we did some deliberate borrowing of foreign exchange from the foreign market when there was a lot of volatility in Indian market. So that also led to little extra borrowing from international market. Otherwise, our debt equity ratio is close to 0.79, which I think is fairly okay.
When are you expecting the payment, the recoveries from the government to come through?
It should happen. We keep getting the under recoveries regularly, but once in a while there are some delays also, so it should happen soon.
In Q4, gross marketing margin were higher, which aided your performance. How have the gross marketing margins been for the Q1, which is happening for now?
You see, normally while refinery margins do vary depending upon the cracks for individual products, marketing margins more or less remain at the same level, except that because they are closely linked with the volumes. So particular quarter, if the volumes do happen, extra volumes because of export or because of things like that, then marketing margins do vary. Otherwise, invariably they remain more or less at the same level.
Okay. Iran waiver has been ended. So what is the compensation? How are you compensating it? What kind of crude strategy you will be adopting?
We procure majority of our crude through term contracts, which are long-term contracts or which are yearly contracts, either calendar year or fiscal year contracts. And we do these contracts with large number of national oil companies in different countries. These contracts are essentially with the national oil companies. And we do such contracts with number of producers and number of countries. We have fixed volumes in each contract and we have optional volumes under each contract. The main objective of having this kind of a crude basket is that if a single source or more than one source are unable to meet the requirement as committed, then we are able to procure the same volume from other countries. The same thing is happening for Iran this year, because whatever we had planned to procure from Iran, we had already provision to procure similar volumes from other sources. Now this total volume cannot be supplied by a single country or a single company, so we will be going to we are already tied up with other possible sources through which we will be procuring this volume.